Now here I am delivering a second module, that is analysis of financial statement. Analysis of financial statement based on the financial statement which are prepared under the financial accounting structure. Which are the topics to be covered under this particular module? That is introduction, meaning, definition, characteristics, nature, limitations, purpose of financial statement analysis, and the important topic, that is tools which are used for analysis of financial statement. So here these are the topics to be covered. So let's begin with the introduction of the financial statement. I just want to mention here that a financial statement is structured compilation of data in accordance with logical and consistent accounting procedures. It means if the accounting procedures are providing the constant information, then and then the analysis of financial statement is possible. The aim of this is to communicate an understanding of various financial facts of an entity. Means whatever the facts are available of the financial statements, that should be provided to all the different stakeholders in such a format, then they can understood and take a decision for their future path of action. In other words, the analysis of financial statement consists in splitting down a composite set of facts or figures into a simple constituents. In that sense, the amount of information to be delivered in such a format that it is to be simplified to understand for layman also. Now, generally, the two types of analysis can be done. One, the analysis of financial statement over a certain number of years. In such a case, we can establish a trend and can visualize the further movement as well. Means that analysis of financial statement has been creating a trend. Fine. We as know that the amount of analysis can be done for the understanding of a owner or a promoter or the third party like a creditors, bankers, lenders and other people willing to know what type of trends are there, and the trend has been created by the organization. So this is the one thing. Now important another thing is the analysis of financial position of the company as a particular date. Here the detailed positions has to be disclosed. Why detailed information is to be disclosed? Because of the information is directly concerned with all the stakeholders. If it is not provided a detailed information, then it cannot be examined. And maybe the detailed information is not provided, that is why the examination may not be correct also. So for the detailed examination, all the information should be provided in a systematic way or in a proper channel. One of the definition important is considered under this financial statement analysis. It is financial statement analysis is a judgment process which aims to estimate current past financial position. So it is a linkages between the current and past positions. Why it is linkages? Because of the one is a trend is concerned. Second is the part of important of analysis of statement which provide a continuous information, and the result of the operation of an enterprise with the primary objective of the determining the best possible estimates and predictions about the future conditions. So in that format, in that sense, the management can take a future path of actions for and or maybe a decisions how it could be moved further and what are the steps to be taken for the company. Let's move for the next important topic, that is types of financial statement. There are many types of financial statements. Here I am going to tell you first another types of financial statement, that is income statement. It is called profit and loss account. As you know, what is profit and loss account? Ultimately, the profit and loss account shows a picture of transactions between the company and the third party. What is your situation at the end of the year? Amount of gain has been raised by the firm, or maybe that it is in a deficit situation. Basically, it gives an idea about the status of an organization that might have been affected due to operations of the company conducted between the two given dates. One is the beginning of the year or the another is at the end of the year. It does not mean that all the time always compare the information between these two dates, beginning and end. It might be compared some during the years also, but ultimately I want to tell you, whenever the data has to be evaluated, it is always evaluated between the two dates. In these statements, the revenue and cost incurred during the given period of time are matched. So expenses and the incomes generated should be matched during the period of time. Other, so as to arrive a decision whether the organization has gained anything out of the operations or it has suffered a net loss. Now, here I am going to tell you the statements. One is an income statement, then now second is a balance sheet statement. The balance sheet is one of the important documents prepared by an organization. Balance sheet is ultimately a position statement. The position statement shows a position of the company on a particular day. How much amount of capital is carried by the company, this capital has been invested in which type of assets in the organizations, whether they have some fixed assets or in a current assets, amount of the debt has been created by the firm or not. So this is a value, and value shows the position on a specific date. Here the documents are prepared by an organization which display the financial position of an organization on a particular day, which portrays the liabilities and other informations along with it. Obviously, a business firm may prepare many other statements which are either mandatory or are needed for an assigning and noticing the certain areas of the organization. That means the amount of statements prepared. There are many types of statements, but one of the statements is important, that is balance sheet. Here the financial statements are indicators of majorly two important factors. As we already know, one is a profitability and other one is a financial soundness. I want to tell you this, both the statements are actually based on above two statements. Why we are preparing these two statements? Because of the company wanted to know that whether they have continuous growth or not. That's the first thing. The second important thing is, from the growth they are creating a wealth creations or not. So from this two understanding, one, the profitability, which is actually giving a path, we have a sustainable growth in the profit or not, and the second, whether we are creating a wealth creation or not. That is actually based on your soundness of the firm. Thus, through analysis and interpretation of financial statement, one can treat informations contained in above two statements in such a way that one can obtain the current profit standing and financial position of the organization. So in that case, the amount of financial informations and statements can be prepared. Now we'll move for the next topic, that is characteristics. Now first characteristics is understandability. Fine. Analysis of financial statement is based on understand. That means who are supposed to be understand? Who is going to deliver this particular analysis of financial statement? The analysis of financial statement has been done by the management. For whom? For all the stakeholders. Why they are actually analysis this? Because of it actually portrays and represent in a simple way that the layman also can understood this statement, and that is why it should be understandable. So the people concerned, excellent feature of financial statement is what? That is easy to understand. To whom it is to be considered? The people who have a reasonable knowledge of business entirety or an activity, as well as if they have a basic knowledge of accounting procedures, they can easily understand and deliver the informations in that format and as they are thinking in their mind. Second is relevance. Now the another important characteristics is creating a relevance between the informations. The analysis done is quite reliable for the decision making of the management. So that means whatever the analysis has been done by the management, they have to show the relevance also. Suppose in the one case, the company's profitability has been decreased because of the cost of product has been rise. Now they are taking a decision that when they are actually purchasing the raw material costs were incurred high, and because of that the profitability goes down. So then they find out the amount of raw material little bit cheaper than the past years, and because of that reason their profitability has increased and cost has become down. So here are the relevance. The relevance they have to express through the analysis of financial statement. So information generated and analyzed has a quality of relevance and helps in evaluating past, present and future events for the business. Next point is materiality. The information analyzed and conclusion don't have the material value. Material value means what? The material value means whatever the analysis has been done and portrayed by the management, that is material. Whenever I am taking a decision which are taken on the basis of analysis produced of financial statement is having some material effect. In case of that information have an error, or if it is incorrect, or there is some part of misinformations, it is incur a substantial loss to the firm in the form of a monetary concern, and that loss would be incurred due to a wrong decision. Next is reliability. In order to use the analysis for further references. Now, how it would be reliable? Reliable on the basis of two important things. One, it should be errorless, and the second, it should be biasless. If whatever the information has been passed by the person or through the channel, if there would be no error and the person is not at all biased, I think so the information is quite reliable. And from that information, whatever the decision has been taken by the management would be accurate. And that accurate decision would be always helpful to increase your profitability, increase your wealth creation, and you can take an appropriate, perfect decision so far as concerned. So this is what all about reliability. Completeness. How it could be completeness? In order to inform an analysis or to be reliable, it should be complete within the bounds of materiality and cost. Any omission or misstatement can cause analysis to be incorrect or misleading. It means that if the informations are omitted, or maybe the informations, all the informations may not be passed out, something has been missing out there, and the statements are misstatement or misleading, then the information is always incorrect. So it should not be happen like that. So incorrect and misleading informations may affect your analysis, and thus unreliable and defective in terms of irrelevance. So the completeness is concerned with the perfect informations, correct informations, and statement has been accurate. Next point is comparability. The financial statement should be prepared in such a way that they are comparable in order to identify the trends of financial position. The trends has been designed on the calculation of the number of years calculations and find out their waves. So the trends has been concerned with the analysis of financial statement and profits trending over the years. Again, it should be designed in such a way that it will help the users to undertake a comparative analysis with better enterprises so well as to know their positions in the industry. So this is what the comparability. The next is two statements. These are the two basic financial statements. One is balance sheet and the second is profit and loss account. Balance sheet, it shows a picture of a position on the particular date. And profit and loss account, it shows a picture of the whole year or maybe the specific period, the profit or loss position, which inform the amount of systematic business work. That means if the business has some cyclic issues or the traditional issue, it could be automatically reflect from these two statements. So these two statements are based for any part of financial statements. The next point is clarity. The financial statement must be so prepared that they can be easily understood by any of the readers from whom they are made. That means the whoever so is concerned with this analysis of financial statement should be understand properly. unnecessary details should be avoided. That means those informations which are not at all reflected anywhere, which are not at all important, should not be considered in this analysis of financial statement. If need be, the additional information must be given in the form of schedules. That means there are many informations which may not be directly included in the financial statement, but it is required to understand or to create the relevance of whatever the information has been disclosed, that the additional information has to be mentioned in the schedules as a footnote or any other format to be informed to all the stakeholders. Like an example, the values of fixed assets must be shown in the balance sheet, but its cost price, its market price, its depreciated value, which method has been applicable. So all this, any informations which is required has to be mentioned in the particular schedules. So that is what all about clarity. Next is based on recorded facts. The financial statements are prepared on the basis of facts record in accounting records. Fine. It is a prime condition that whatever the information has been provided by the account departments to the managerial departments, it is assumed that the information has been passed out to us which are absolutely right, correct, and the only facts information has been delivered to us. Because of this fact informations only to be analyzed in future. That is, they are prepared on the basis of these transactions or business transactions recorded in the books of accounts only. Thus, it means that the fixed assets or any other information are shown with their cost, or the only those transactions are included in financial statement which can be based on monetary terms. Next is multi-purpose. The profit or loss revealed by income statement prepared for different purposes are bound to differ. Listen, I just want to mention here the statements cannot be remain same, or the whatever the information are given in the statement, it does not mean that all the statements can be understood only in one format. It can be understood in any format. It is to be understood according to the requirement for the particular object. For instance, from the profit and loss account, the profit could be calculated variously, like a gross profit, net profit, capital employed, profit on a shareholders fund, profit on equity shareholders fund. So many type of profitability has been calculated. This calculations is always for a different object or different purpose. For income tax purpose, for managerial remuneration calculated purpose, for the consideration of a dividend payout. So any particular object, this would be changed. Fine, this is all about the characteristics. Now we move further. The next topic is nature of financial statement. Nature of financial statements are prepared for the purpose of presenting a periodical review or report on the progress by the management and deal with the status of investments in the business results achieved during the period under review. It means what? The company is analyzed the financial statement always on